Welcome back, everybody, to the Informed Home Buyer Podcast. I'm Rich Curtis, and I have my co-host with me, Dave Miller. Good morning, Dave. How you doing?
I'm good, Rich. Thanks for having me.
All right. Today, we are talking about the upcoming Fed announcement. We are 6 days away from the Federal Reserve making an interest rate announcement. We're going to be talking about all of the things that Dave and I look at to have an idea of what the effect of that announcement is going to be. We're going to talk about the effect on you, whether you should pay attention to this at all, when you should start paying attention to this. And we're going to break down the 5 key economic metrics that you hear about, all that gobbledygook alphabet soup that you hear on the news that you can never wrap your mind around. We're going to break down each one of those: CPI, PPI, unemployment, all of that, put it in terms that anyone can understand, and whether it goes up, down, or stays neutral, what that might mean for mortgage interest rates. We're going to get into all of that today. So if you're wondering what's going to happen with interest rates here at the end of 2024 and into Q1 of 2025 and how to wrap your mind around that, you are in the right place. Stick with us. And so I'm going to kick it to Dave right away. Like I said, we're going to go through these core 5 metrics that we look at. And just so you know, there is, when we're interpreting the metrics, that's pretty cut and dry, but there is a lot of crystal ball work involved in predicting where rates will go. There's a lot of confidence-based moves that happen based on what the chair of the Fed says. And, we are moving into a new administration in the White House, which will, no matter who gets in there, they always make some changes, some economic changes. And so there's always some uncertainty baked into the things we're saying. So you have to take everything with a grain of salt, but we're going to try to give you a good education so that you can have an idea, even as they make those changes and you see these core economic numbers move, what that might mean for you. So Dave, let's jump right into it. You want to start with CPI?
Yeah, let's start with CPI, Rich. Those numbers came out this morning, and this is, in fact, I'll just read this directly. The CPI is a measure of the average change over time in the prices paid by urban consumers for a market basket of consumer goods. And so what this is doing is it's measuring these costs based on predetermined time. So is it month over month? Is it year over year? And so they look at these different numbers, and what this is doing is giving us a read on inflation. And that's from a consumer's perspective. You also mentioned PPI, which is a producer price index, and that's for the cost and this metric from a producer or manufacturer's perspective for the goods. And so
Gotcha.
I know
between CPI and PPI, we're getting sort of both sides of the story: what it costs to make it, what it costs to buy it.
That is correct. Yes. And, for producers, it's the cost of materials and everything that's involved with them to produce those goods. So it's a checks and balances on that to make sure they're also in line with one another. And I think that the important thing, and you mentioned that, there's a lot that we pay attention to. You listed 5 different, bullet points of things that we were going to discuss on this call. These are things that you and I and specifically me, I pay attention to on a regular basis as a home buyer, somebody that's considering buying a home. You listen to the news, you hear all this stuff, but it might not really resonate with you as much until you go into contract or you've made the decision that you're going to buy a home or maybe refinance. But typically that's as a consumer when maybe you want to start paying attention to these types of economic data that are going to affect your ability to purchase a home and how that affects your purchasing power.
Yeah, it's a really good point. So the average person sitting on the couch at home right now doesn't really need to be paying attention to the CPI, the PPI, the unemployment data, the inflation rate, the 10-year T-note. These are not things that you are tracking in your everyday life. This is something that comes into play within a short window of time when you're making a decision to buy a home. And it's not usually valuable as a go, no-go decision point, meaning you can't time the market. You can't make the decision, am I going to buy a house based on this? But within the window of time, if you've decided I am going to buy a house, within that window of time, you can follow these metrics to get a sense of when's the best time to lock in a rate, or if there's an upcoming Fed announcement, is it worth waiting a week or two because it sounds like we might get a shift? This is something you're paying attention to within a tight window of time. We're assuming if you're watching this podcast right now, you are probably thinking about buying a home at some point soon. So this type of thing might apply to you right now in this moment.
Yeah, and Rich, you bring up a really good point. And the one thing about this business is there's always announcements. There's always some, metric that's coming out. That's every week. There's these, economic indicators that are going to be reported on, and when the feds are going to speak and they're gathering this information, this is going to make their determination. But this is perpetual. So, it's not, we're not in a vacuum here that this is going to set, what's the Fed announcement that's coming next week. And today's CPI number, that's not going to determine what rates are going to be for the next 6 months, right? It's really what these are really affecting our short term. In the short term, what can we expect interest rates to do? Because once we get beyond, 1 month, 2 month, 3 months, then there's, a lot of other indicators that are going to influence, that are out of our control, whether that's wars, international, happenings, economies in other countries. There's, possible tariffs, there's just so much that's out of our control. So we want to focus on the things that are in the short term that are going to determine when I'm ready to buy a house, how is my purchasing power going to change in the short term?
Yeah, and I think the media presents these things like when you're watching these things on the nightly news and hearing about them that way, instead of hearing about them from skilled practitioners who work in the industries that are affected by this. There's a real hair on fire approach to all of this data that this, oh my God, inflation's up, CPI's up, CPI's down. And really, none of this means a darn thing to you in your everyday life for the most part. And these things, as you'll see by the end of our conversation, don't actually usually swing the needle that far. So, we could get some great clicks and a ton of views here if we take that hair on fire approach and say, oh my God, Fed's coming up. What's going to happen in your life? But the truth is that the US government and the economy turns like an aircraft carrier, not a Porsche 911, right? So no matter how incendiary people try to make these things sound, we're really talking about slow incremental changes here that aren't going to swing things in your life very dramatically or very quickly.
Right. And that's a really good point, Rich. And so when somebody that's on the couch decides, or wherever you're sitting at a desk, to decide that you're ready to, dive into this home buying, whether it's an investment property or a first time home buyer or move up, is, what's the current market for mortgage interest rates today and what's affecting those? And so, usually within that window of time, whether it's a month to 3 or 4 months, we usually are looking at a half a point swing in interest rates on the average. I've been doing this over 20 years. And if someone comes to me and says, hey, what's today's rates? I'm looking to buy a house. So if you and I are working with a typical home buyer that's going to have, we'll say a $620,000 purchase price with a $500,000 mortgage, right? We're looking at probably $60 a month per eighth in interest rate, one way or the other. So if someone comes to me and says, yeah, I'm looking to buy this house, that, there's a good chance that you might pay $120 more a month by the time you get into contract, or you might be $120 a month cheaper. What we don't want to do is you can't time it perfectly, or is have that impact your decision, because there's other economic factors that are going along, whether it's home appreciation or some other, things that are completely out of your control.
Yeah. I mean, to put that in perspective, that swing, you're talking $120 a month by 12 months. You're talking $1,440 a year. That's going to change things, but we're looking at 3 to 5% appreciation over the next year. So you're looking at on a more modest house, you're talking about $620,000, but on a $500,000 house, you're talking about $15,000 to $25,000 in swing in the cost of the home potentially over the next 12 months. So that you're sort of stepping over dollars to pick up pennies in this scenario. If you're trying to time the market and you wait for a whole year trying to save $120 a month, you're going to lose $15,000 to $25,000 in appreciation over that time. And it's going to cost you that much more to buy the house. So it's sort of a double loss. It's a $30,000 to $50,000 overall loss, because not only do you have to pay that much more to get the house, you lost out on it having that appreciation in the bank for yourself. So we lose so much more over time in an appreciating market by sitting on the fence than we'll gain by getting these interest rates. To put this into perspective on buying power, a cool metric you had shared before we got on the show. Let's just tell everybody, for every 1 point in swing in interest rate, how does that adjust the average buyer's purchase power? By how much?
It could be $20,000 to $30,000 in
Yeah.
purchasing power. And what that is, it's based on your ability to qualify. So there's a couple things. Is you may be able to afford that $20,000 or $30,000 more in purchasing power over the life of the purchase or the loan, but some folks are right on the edge. So if you're looking at a $500,000 house and your debt to income ratios kind of towards the higher end or close to maxed out, and if rates go up, a full percentage point, you might be looking at now a $470,000 purchase price, just in order for you to qualify based on your down payment. So can be some pretty big swings there. But typically, once you've made up your mind to purchase, we're within a window of time. I am not going to tell you, as a conservative mortgage loan originator, I am going to take a conservative approach. I'm not going to tell you the lowest rate that it's been in the last 6 months and have you base off of that. I am going to tell you what the rate is today, when you're ready to start going out and looking, and let you know that be prepared. And let's base this if rates are a quarter point higher. And then if they're lower, it's a bonus, but that shouldn't affect your decision making. Because the last thing you want to do, Rich, is take someone out, show them a house, they fall in love with it. By the time they go into contract, they can no longer afford that house. That doesn't help anyone.
It's terrible.
Yeah.
And so as a backdrop for what we're going to share with you, these swings are much smaller than what we're talking about. So 1% swing is going to cost you between $20,000 and $30,000 in buying power. If it goes down 1%, you can buy $20,000 to $30,000 more house than you could at about the same cost. If it goes up by 1%, you can buy $20,000 to $30,000 less house at about the same cost. But within any 3 to 6 month search period, we're probably max talking about a swing of about 0.5%. So now we're only talking about a $10,000 to $15,000 swing in purchasing power. And what we're going to talk about today is 6 days from now, the Fed's going to announce whether they're going to drop the federal funds rate, the short-term rate, by 0.25%, a quarter point, right? So now we're cutting that down in half again to only talking about a $7,000 to $15,000 swing. And that's not even a 1-to-1 drop to mortgage interest rates. So if it had any effect at all on our mortgage interest rates, it's going to be even less than that quarter point. And so it's even less buying power impact of what we're talking about. So by the time you start to try to track and process CPI, PPI, inflation, all of these things, we're talking about a net effect of less than a quarter of a point overall on you, and in the low thousands in terms of a buying power swing on you for each of these announcements, each of these decisions. And so that's why I say, when the media's got this hair on fire approach to the Fed's going to make their announcement and the world's going to end or whatever, it just isn't that sort of thing. These are small incremental swings.
That is correct, Rich. And I think the number one way of thinking for folks today, and folks that have, I don't know if you want to call it short-term or long-term memory of when interest rates were in the low 3s, high 2s, that is not coming back in the foreseeable future. So if you're waiting for rates to get back down there, you're going to be waiting a long time, and you're going to miss out on potentially miss out on some significant appreciation. So everything that I'm reading, I'm paying attention to based on the health of the economy, is that interest rates will probably fluctuate in the 6% range. We might get into it'd be great if we got into the mid 5s, but plan on 6 to 7% is a reasonable interest rate based on the health and the state of the economy. The economy's doing really well or moderately well, interest rates are going to stay higher. So there's, we talked about inflation numbers. If inflation, starts to go up quite a bit, then the Feds have to raise those interest rates, which are going to affect your interest rate. So, but right now, everything seems to be relatively in check. So they're going to incrementally lower interest rates, which will incrementally help mortgage interest rates but we're not going to get into the 4 or the 3% interest rate range.
Yeah, correct.
So.
And you can, there's 4 or 5, different, core agencies that announce their predictions. We can do a whole podcast on let us know in the comments down below if you guys want a podcast on who makes these long-term mortgage predictions, and we can kind of break those down. But you've got National Association of Realtors, Mortgage Bankers Association, Fannie Mae, Freddie Mac, all these, organizations will put out their predictions for where interest rates are going to go over the next 5-10 years. And again, there's a lot of crystal ball work in this, and they're going to be from bearish to bullish in, depending on that particular agency's bent on things. But all of them relatively agree that in the, near term, in the next 5 years, we're not going to see much below that 5% range unless there is another big major upset in the economy, unless the government starts printing off dollar bills again, basically,
Right.
to try to fix things.
Yeah. And then again, unless there's a major issue to see home prices for whatever reason come down significantly, which we saw, 18 years ago or whenever, back in 2007 to 2012, whenever that was, we're not going to see that. So folks that are hoping for that, we may see a little bit of a reset, but it all comes down to supply and demand, right, Rich? On your side, what the inventories look like, and inventories have in some areas increased a little bit, but not enough to make it a buyer's market. It's still, leaning towards a seller's market.
We're still a slight advantage to seller's market. We're bouncing in that 3 to 4 month inventory range, where we were like 0 to 1 month during the pandemic and 2 months exiting the pandemic. We're in the 3 to 4 months. Really, 6 months inventory is when you get to that sort of neutral market. And what we saw back in 6 months or more can become into a seller's market. A buyer's market. What we saw in the Great Recession there, like you said, 18 years ago, was 18 months of inventory, a fire sale. So
to be a home buyer right now and be hoping or waiting for interest rates to come down quite a bit, what's going to happen if that happens is if we see just a single full percentage point in mortgage interest rates go down, the buyer pool is going to explode with the number of folks out looking for homes. So what does that do? It reduces inventory and it drives up the price. And
that is a dance we're always sort of struggling with, but you're saying as a general rule.
Yeah. And as a home buyer, let's not wish for that, because you're not going to be any better off. Your competition is going to be greater and values are going to, most likely go up. So we want to see slow incremental decreases, so that there is not this large influx of buyers higher than what there is now hitting the market to drive prices up, and interest rates will certainly influence that. So ideally, if you get a home, you get locked in, it's advantageous if down the road you have the ability, when interest rates do drop, that you could potentially refinance and lower your interest rate, but at least you're in the market and an appreciating market.
Yeah, and if you're interested in doing a deeper dive on that, there's a video on the channel. It's called something like "Did Barbara Corcoran Get It Right?" And there's another one that "Should I Buy in 2024? Buy or wait? Buy now or wait?" And it breaks that down. The industry metric is that for every half a point in reduction in interest rates, we see 6 million more buyers drop into the buyer pool. So for a 1 point swing, to Dave's point, you're talking about 12 million new buyers that now have dropped. The prices have dropped to a threshold where they can afford it, and now they fled into the market and they gobble up all that inventory, and we're back to like 2021 sort of insanity with competition on prices. So it's kind of a double-edged sword. What I'm seeing in the marketplace now is the real reality of interest rates and how they impact people is that people still got to move. People still have an ailing family member they want to go live near. People are still forming new families and getting married and wanting to buy a house. The narrative that your house is the biggest investment in your life and that's purely a financial decision has kind of obscured people's thinking and eroded people's thinking in the way they make these decisions. And more often in my job, people are making these decisions emotionally because it's something that they want for their family, and they don't want to wait too long. So people have been waiting since interest rates doubled in July of 2022. And what I'm seeing in my own business, and Dave, I don't know if you're seeing this with the phone ringing now, is people are like, whatever the interest rate is, I got to move, or I want to move. I'm ready to do this now, and I'm done waiting. And so we've hit kind of a threshold in the market where people are starting to understand these are the interest rates. It is what it is. And I still want to move forward with my life. And that has a bigger effect than a quarter point move by the Fed.
Well, 100%, Rich. And what really, kind of spurred a lot of that on is through all that inflation that we had the last several years, and inflation up, 8, 9%, is rents went up significantly. And so, we've seen kind of a flattening in rental rates, not going down, but relatively flat, just recently. But if you are renting a home, to support your family, you have a new family, and you're paying, $3,000 or $4,000 to rent a home, and you could potentially buy a home and have a
Yeah.
mortgage within within a putt of what you're renting for. That may make sense for you. So unless rents are going to drop significantly, you might be in a situation where, like you said, there's life circumstances that are going to encourage you, or the
Yeah.
timing is right for you to purchase a home.
Yeah. So all this has been a big, long backdrop to how Dave and I think about these things, and to give you a little sense of calm and comfort around the news you hear about this kind of stuff, that this isn't that big of a swing. This isn't that big of an impact on your life. But for those of you who really like to track this stuff, for those of you who are a little bit of a data geek like me and like to get a sense of where things are going, or maybe you're a high anxiety individual and it makes you feel better to get a sense of where things are going, let's break down the numbers. So we started with that consumer price index, which is basically the current cost of a set basket of goods. If you were to go out and just pluck them off the shelf and purchase them right now, they announced these. They just did this week. So Dave, was CPI up, down, or level?
It was, from all intents purposes, it was level. It was up, I think, a 0.1%, and so that's flat, and that's enough to say to the feds that, we're, and what I'm reading is, and I'm not making this prediction, but there's about 100% chance that they're going to lower interest rates a quarter point next week.
Yep.
And that's based on that CPI number reading, that is, the inflation number, which is the Fed's main charter, is to keep inflation in check.
So had CPI gone up, meaning that basket of goods cost more this week than it did. Oh, they're announcing these weekly or monthly or quarterly on the CPI for us.
Monthly here. These are looking at typically the previous months,
And
and
we're
there's
getting
also,
a month over month, year over year read on
yes,
it. Yep.
correct. Yeah, there's two different
So had
numbers and
that
different reads.
basket of goods cost me more this month than it did last month, that might make the Fed stay level or raise rates, correct? Because they're trying to curb inflation.
That is correct.
And had it
Yep,
gone down dramatically, it would be a point in favor of lowering, or lowering more dramatically.
that is correct. Yep,
Gotcha.
and
So for the people on the couch, if they're watching and the CPI numbers come out on the news, if they're up year over year, up month over month, that's an indication that we likely are going to see flat or worsening Fed interest rates. Yes?
that is correct. Yep.
Okay. And if they have gone down, if they're flat or gone down, then we're going to see either nothing happen or a modest reduction.
That is correct. And then there's other indicators when those are flat and it's maintained flat for a period of time. Unemployment figures will have some impact on that, because they certainly want to stimulate the economy. And what stimulates the economy is lowering the interest rates. So,
Correct. Yes. That's one of our other indicators, is the unemployment rate.
right. And so, unfortunately for the feds to, as they were bringing down the inflationary rate, they want to see unemployment numbers go up. That means you're slowing business, you're bringing down the cost of goods to a lower inflation, but that means there's less employment and less employment opportunity. So, what's actually caused this to go a little bit slower, in terms of lowering the interest rates and bringing down inflation, is a consistently favorable unemployment rate. Um,
Yeah,
you know,
directly after the last Fed announcement, unemployment numbers came out, and we'd actually added jobs, right? And that kind of threw some ice water on the Fed's sort of reduction plans.
Right. And then there's always these trailing numbers that says, yeah, maybe it wasn't as great as those numbers indicated. And so,
Yeah,
it seems like a lot of smoke and mirrors, but they get initial numbers, and then the numbers get revised to the actual numbers, because it takes some time
yeah.
to, extrapolate those figures out of the economy. So,
And did we
yes.
get unemployment numbers this week, or are those coming up?
Let me look at unemployment. What do we got next on the calendar for this week here? So right now we got, and there's different. So as different announcements are coming out on economic data, we're going to get levels of impact to the market. So like the rest of this week, basically we just had this week was just the CPI number was the main that had and the PPI number that had moderate impact on what interest rates are going to do. So let me look, and looking at the calendar, I think next week we will see unemployment rates come out. So these are things that we're paying attention to. They're constant.
Yeah. And so with unemployment, if we see an increase in unemployment, that is a point in favor of seeing short-term interest rates. And again, what we're talking about now is the effect on the Federal Reserve interest rate and federal funds rate, which is a short-term cost of borrowing money. This is not a direct one-to-one effect to mortgage rates. We'll get to how this affects mortgage rates later. But if unemployment numbers go up, that's a data point in favor of seeing that the Fed will reduce.
Yep, that is correct.
And flat is flat, and down is a point in pumping the brakes on reductions.
Yep, that is correct.
And so, if we saw a lot of jobs added to the economy, would they potentially go back to increasing rates or likely stay flat?
My guess is we would likely stay flat unless inflation started ticking back up. So it's okay if we add some jobs, but inflation and CPI stays in check. So again, the number one charter is that inflationary number for the Federal Reserve to keep that at their target 2%, or I don't know that exactly what they're, but it's in the 2% range in which we're at right now. We're in that 2%. And when we say 2%, we're saying 2% to 3%. So that front number at 2%, I think, is always favorable for the Fed. And once it hits, just like us, that front number of a mortgage interest rate, if you're at 6.875 sounds a lot better than 7%, even though it's, it's a minimal difference.
Yeah, and I think we'll get to the sort of, because I think that inflationary number is sort of the shortcut to all of this. If you're only going to follow one number, really, but let's go back to, so we've got unemployment, we've got consumer prices, PPI, the cost of a basket of goods from a production perspective, similar to CPI. If it's going to cost more to produce goods, then we're going to see them not lower rates or worsen rates. Yes,
that is correct. In fact, let me tell you right here. And here is Producer Price Index, a broad measure tool that tracks average change in selling prices for goods and service and construction. The PPI is calculated by the Bureau of Labor Statistics, and there's a lot of things that go into that, so we won't spend the time on here. But you hear these terms and these types of economic indicators. We pay attention to these. We see what the effect's going to have on the short-term interest rate. So we're always kind of watching, and we know. So what happens for a home buyer is when you really need to pay attention to these numbers, or it's going to affect you, is you're in contract and you're in your locking window. You need to lock in an interest rate, and that's where it becomes stressful. It doesn't need to become stressful because you know what your range is, but you're just hoping for the best. No one wants to pay more within that window. So we're paying attention, and I can give you advice. Here's what the projections are going to be. You have a 70% chance that rates are going to get worse next week, or the cost to get that rate. So let's just lock it in today and move on, or the opposite. Can I be wrong? Yes. But we always talk about the pros and cons and what's expected, and collectively we make that decision together. And you, as the consumer, you pay the bills, you pay your mortgage payment. I'm going to share with you everything that we anticipate to happen and let you ultimately make that decision with my guidance and expertise.
Yeah. And it's worse if we're seeing more than one of these indicators going the wrong way. And CPI and PPI are going to track relatively, close together. So if we're seeing, CPI and PPI come out higher, that's a sign of inflation. We're going to see rates stay the same or worsen. And if we see them both getting lower or better, we're going to see flat or easing on the rates. But just like, if you're old guys like Dave and I, you might have had that stereo in your car at home back in the days where you had the equalizer and you had 15 little things that you go up and down. If you fling one or two of them way high, everything gets wacky. You're trying to get all of them kind of right down that middle range. That's how these 5 sort of key economic indicators are. If you get 2 or 3 of them out of whack, things get worse quick. So any one number, unless it's the inflation number, getting out of whack is okay. That's not looking good. But when we have them all going the wrong way or all going the right way, that's when things start tracking better.
Yes,
and so to think about it.
Yeah, and ultimately what we pay attention to, or what I'm paying attention to when it's time to, in your window of locking interest rates and where we're at, we're looking at the 30-year mortgage-backed security, which is not a readily available indice. I have access to it. I pay for a subscription to watch it, to see what's going on all day, every day, and what those movements look like intraday. As a consumer, and I think I've mentioned to you, Rich, is a lot of folks, and even in the industry, pay attention to the 10-year treasury yield. And that's,
Which is something that's easy to Google, and you can just look at the
yeah,
current yield of the 10-year T-note right now.
yeah. And I have a chart. If you want to, if I want to be a presenter here, I could share a chart here, and just to show. Here, let me go slides or share screen here. And before I do this, let me.
And so what Dave's getting up is a chart of the 10-year Treasury note bond yield, and there is a relatively predictable premium above that is a more direct shorthand to what's going to happen with mortgage interest rates.
Yeah, and so let me share this here. You might be looking at this here.
Not yet. Let me add it to the screen. There we go.
Okay. And I don't know. So if you're looking at the 10-year Treasury bond, in fact, let me go to a different share, Rich. This may not be as good. Don't share that just yet. Let me get to a chart here. There we go.
You want me to remove this one and put something else up?
Yep. I'm sharing
All right.
again. I'm not sharing a web page. I'm just sharing.
All right, there we go.
Okay, so this just kind of shows you here the 30-year fixed mortgage rate is the dark green, and the 10-year Treasury bond, Treasury yield. If you watch, you could see how these move in parallel to one another. And over time, and you go back, I mean, shoot, since 1972, this chart goes back, you could see how they tend to mirror one another. And there's usually a spread, and that spread could be anywhere between 1 and 2.5 points. Right now, we're tracking a little over 2 points between the 10-year Treasury and mortgage rates. And you can see here as this gap widens right here. And so as a consumer, if you follow the 10-year Treasury, you could kind of see, okay, which way are mortgage rates trending?
Yeah.
And so again, I'll probably,
And,
yeah, go ahead,
and
Rich.
even if you were to just Google what the current, you just Google,
Yep.
today's yield on 10-year Treasury note, and you could add 2 to 2.5% on top of that, you'd be at a reasonable approximation of today's paper 30-year mortgage rate.
That is correct. Yep.
Yeah. And so this, when we've talked about CPI, PPI, we've talked about unemployment. These are all sort of indicators that can give you a point in a direction. But the two numbers that we're talking about today that really are a more direct read on what's going to happen are the 10-year Treasury yield, because you can make a real direct prediction of what interest rates are doing. So if you're looking on the day and the T-note's way up, you're going to know that interest rates are way up. And if the T-note's way down, you're going to know that interest rates are way down. So it is a bit of a consumer shorthand that just via Google search you can use.
Yep. Correct. All right. So,
and then we'll talk about inflation, which is the other one that's really just an easy, direct predictor as well.
yeah.
But let's finish up here on the T-note.
Yeah, let's stop that share, Rich, and then I'll go ahead and go back to the studio here, so we're not double sharing ourselves. There we go.
All right, sounds good.
So people only need to see us once, not twice, right? In one window. Yeah.
So that right there gives you an idea of all these metrics. That the yield on the Treasury, 10-year Treasury T-note is the more direct, easy way to make a prediction. And then the final one we're going to talk about is just the inflation rate itself. So Dave, kind of explain the dual mandate of what the Federal Reserve is supposed to do, what they're looking for inflation rates, and where we're at now based on the most recent inflation announcement that we just had.
Yeah, that's a good point, Rich. And I'll read specifically. So when inflation rate rises, interest rates typically rise. Also, the central banks like the Federal Reserve use higher interest rates as a tool to combat inflation by discouraging excess borrowing and spending, thus helping to cool down the economy and stabilizes prices. Essentially, lenders demand higher interest rates to compensate for the decreasing purchase power of money during inflationary periods. And so I think, again, the bank's mandate is to keep inflation, the goal target, in the 2% range. So they are the biggest tool at their reserve the biggest tool they have is the interest rate. and that short-term interest rate is their tool to either cool down or warm up the economy.
Yeah. And so that the Federal Reserve has that dual mandate of keeping inflation down and keeping employment high, which are kind of in direct conflict with each other, as we explained. Like right now they are raising interest rates, which is going to produce more unemployment. So their dual mandate is a struggle at times, but they really only have two levers they can pull. They can print money or they can raise interest rates. So during COVID, when people weren't working and things were sketchy in the economy, we printed a bunch of money. During the Great Recession that Dave and I went through at the beginning of our real estate careers, we printed a bunch of money to stimulate the economy. We went a little too.
The term there, if you recall, was quantitative easing. And that's that's a whole separate deal. And that's where the Federal Reserve were buying the mortgage-backed securities, and there were billions and billions of dollars earmarked to buy those mortgage-backed securities, which arbitrarily kept interest rates lower to help stimulate the economy. So to your point, Rich, that's one of those levers that they were pulling.
Yeah, and they were supposed to stop, and it was supposed to go back the other way. And this is sort of macroeconomics, but they never really stopped. They never stopped quantitative easing. They never really stopped printing money. And so you can draw a through line from the Great Recession to COVID of how we got into the inflation problem we have now, where the only lever they could pull was they doubled the interest rates overnight in July of 22 because it was getting out of hand. So their target when they're increasing interest rates, their target is to get inflation at around 2% and kind of keep it there, 2% per year. So where were we at the last announcement? Where are we at now? How's inflation looking right now?
It's good point, Rich, here. So looking at the CPI numbers is going to be that most trailing number. So I think we were at 2.6 last time period. Today we went to 2.7, which is going to be their measure. So, that's, as I mentioned, that's why they're going to keep the interest rate, or they're going to lower right now. So so at 2.7, so right now the annual inflation rate in the US rose for 2 consecutive months, 2.7 from 2.6. Again, they're going to, drop that quarter point because we're still in that 2% range. That front number is at 2%. Maybe if we had seen 2.8 or 2.9, maybe a significant movement that said they would have held flat. I wouldn't see, anytime we're in the twos, they're not going to turn around and increase interest rates, right? They're either going to lower or stay flat. And so that's really what we're paying attention to.
Yeah. And they're also trying not to crush the economy. They don't want to see a 1 in front of they are trying to keep it in that 2%, 2.0 even range is their target to get to. So right now we saw a 1/10% uptick in the inflation rate, month over month, but the CPI and PPI are relatively flat and level. Unemployment's not bad, all things being equal. The market has baked in a near 100% confidence level that 6 days from now, the Fed is going to announce a 0.25% basis point drop in the short-term funds rate. And so, we are looking at all 5 of these things. But again, you can really just look at that 10-year Treasury T-note, look at the inflation numbers and get a sense. If the inflation numbers are going up, they're going to hold flat or raise. If the 2 is the front number, they're probably going to hold flat. If it got up into the high 2s or 3s, they're probably going to raise interest rates. If we've seen it stay flat or come down, they're probably going to lower interest rates. And that decision will be influenced further by some of these other metrics. So right now we're planning on that 0.25% basis point. Dave, are we going to see a quarter point drop in mortgage interest rates, or has the market already, because we have 100% confidence, has the market already baked that 0.25 into the cake and it's going to stay about what it is today?
That is correct, Rich. That's already baked in. They already knew that was coming. The expectation was, that CPI numbers were going to stay in check. And so that was baked in. And, there's still some arguments about did they initially lower too much too fast, because then we saw some hiccups, 6 months ago. But we've kind of weathered that storm. And since the economy seems to be humming along okay, it seems that, that's already baked in. And so for the consumer I would anticipate that interest rates are going to stay within the range that we're looking at right now. So if you just say, I'll just give you a range, 6 to 7%. If, we see a little bit more favorable movement, we may see high 5s. And again, this comes down to down payment, credit score. Each borrower is unique, the loan program that you're looking at. So But again, once you make that decision, you'll know where your rate is, your individual rate, independent of where they are for other folks, right? Like every time
Yeah,
I talk to
correct.
someone, it's what your individual rate is for your profile. And,
Yeah.
I run into this a lot when I'm talking to folks and I say, here's your interest rate. And someone will come back to me and say, oh, my best friend's neighbor's cousin just said they had a rate of X. Well, their profile is completely different. So, we're talking apples and apples, you'll know what your rate is compared to someone else that's the exact or very similar profile to you as a borrower.
Yeah, and the two biggest effects on your personal rate are going to be your credit score and your down payment amount. If you go into the
Yep.
Informed Home Buyer podcast playlist on my channel, you'll see we have an episode on each of those subjects where we do a deep dive on those, so you can get a better idea of that. But we can't legally or responsibly quote an interest rate on the podcast because we don't know your specific set of factors. So
Yeah.
Dave's always going to quote a range when we're on here.
Yeah, and I think the number one thing too is we talk about these are ways that you can go out as a consumer and see what's going on. Been doing this a long time. Best thing to do is talk to us, have a conversation. If you feel more comfortable having me track this for you with saying, okay, we're within your window, pay attention to these items. But also creates a lot of stress for folks because it's out of your control, right? You're making some informed decisions based on what's going on in the economy, and you're aware. But again, it should not impact your decision once you've made up your decision to buy. You understand the market that you're in, the window that you're in. 90% of folks that I'm working with that say, hey, Dave, you tell me when you think it's right. We'll have a conversation. We'll lock in the interest rate. And there's always those, those folks that I explain or educate, like what we've done today. And they call me up and say, hey, I see the Treasury yield's up. We're probably not locking today, so that's fine. That's great. Like, that I'm not making that decision. My company's not making the decision. It's the state of the economy and these yields that are going to affect what your rate is.
Yeah. And so from that 30,000 foot view, if you are more than 6 months out right now from buying a house, then I would be ignoring the Fed announcements. I would be ignoring the CPI. I just wouldn't be engaging with this material. It's not going to be of a lot of value in your life. If you're buying the next 3 to 6 months, start paying attention. But if you don't want to pay attention, get a trusted mortgage lender. If you're in our market, give Dave a call. If you're not in our market, we can give you a referral, or just get someone and trust, and let that mortgage loan originator be your guide to what's going on with the interest rates, what's likely to happen during your period, and when is a good time for you to be floating, and when is a good time for you to lock in an interest rate, which, by the way, is only possible to you to lock in once you're in contract. So when we're talking about floating that rate, it's during the initial few weeks of your purchase period. That's when you're deciding whether or not to lock it in or not. But if you are a data geek and you like to keep track of this stuff, these are the 5 numbers that you can watch. The 2 shortcuts are that inflation rate and the 10-year Treasury T-note. I hope this is giving you guys some perspective on how to kind of read the tea leaves. And also, the biggest thing I hope you've gotten out of this is to not be sort of buffeted and emotionally pushed around by the sort of hair on fire approach that the media takes to these numbers. It actually isn't that big of a deal in the long term for most of you. You can shortcut to a couple numbers and then go on about your life without stressing about this stuff too hard. And you can trust your trusted professionals like Dave and I, or whoever that is for you in your market, to help you make sense of this sort of stuff.
Yep. Well said, Rich.
All right. Well, as usual, thanks for watching, guys. Thanks for making it to the end. You, again, have listened to us chat for 43 minutes. You are an absolute rock star if you've gotten to this point in terms of being an informed buyer and putting yourself in the best position to get the best deal on making a real estate purchase for you and your family. So pat on the back to you. Thanks for watching, and we'll see you on the next one.
Bye. Thanks,
See you,
Rich.
Dave.